We see the impact of Omicron evident in the pound this morning. I wonder how this is going to play out in assets more broadly, though, because the UK story, yes, there's a big focus on Omicron right now, but of course the booster rollout is more advanced, and the UK seems to be attaching a lot of significance to the booster and the role that that can play. In the rest of Europe, we've seen very successful use of COVID passes. We've seen lockdowns to tackle previous outbreaks that maybe now are helping, of course, in Austria and Germany against Omicron. So help us understand how Omicron plays out in Europe from here.
Yeah, the first channel through which COVID political and uncertainty really plays through into UK asset prices is really the Bank of England policy outlook. And I think, that's the channel through which we're looking at all of this uncertainty and how it feeds through into asset prices. That we've had the view for some time now that that we don't think the Bank of England is materially behind the curve. We don't think there's any risk that they're going to be slamming the brakes on in terms of interest rate rises over the next cycle. And our view is at best, even in a decent macro environment, policy rate goes to 0.5% next year. So that's significantly less than the 1% that's priced into markets. And really this week, it is how that uncertainty feeds through into policy responses, not just from the COVID front, but also on the monetary side. And I think that's really where we think that lends itself to a dovish tilt across UK and European assets in the short term.
Good morning, Viraj. Just following up on Anna's question there. Obviously, Omicron has led the market to catch up with your view on the Bank of England, that they're not going to slam on the brakes. And as you say, that's kind of the obvious way to play Omicron. One of the things I'm trying to work out is, how do you play it in the rest of the Europe? Is it through the equity market? Is it through FX? What is the channel or the lens that we should be looking through this latest surge, where at the moment it seems to be more about case numbers rather than fatalities, and we're still very, very uncertain what is going to be the stress on the healthcare system?
Yeah, I think the divergence trade in the FX market makes sense, staying underweight, obviously, those currencies that have obvious risks around Omicron. So underweight European FX for sure is our favorite way of playing this. I think in the equity space, it's a lot less clear. And I think, obviously, not least given when you have all of this uncertainty around Omicron, the biggest, I guess, sting in the tail from equity markets will come from hawkish central bank activity, and especially a Fed on autopilot. So, a Fed on autopilot looking to continue unwinding monetary stimulus at a time when you have all of this uncertainty, for us, is a really dangerous mix for risky assets. And I think, in our view, you kind of want to be de-risking in the next couple of weeks, or especially this week, just given that risk of that dangerous combination in the next couple of weeks.
If you want to be short the pound, then, Viraj, what is the best way to play that right now? And how do you see, as the market has caught up with your view that there will be a hold this week rather than a hike as had been previously anticipated, what is the best way to play it? And how do you expect the pound to perform from here?
Yeah, we've come full turn on the pound. Certainly having a fairly bullish view at the start of the year, a lot of political uncertainty unwinding, a lot of cyclical optimism. All of that seems to be about face at the moment. And I think, in terms of the purest way to play this is really looking for divergence trades in the UK versus US. It's the obvious divergence policy between the Fed and the Bank of England makes cable down to 130 a risk in our view in the next couple of months. But I think a cleaner way to play this is really looking at, say, playing a short sterling against long Aussie, for example, where the narrative in the Aussie dollar has turned from obviously a huge COVID uncertainty risks over their summer, things starting to look a bit more upbeat there, relative to obviously the obvious headwinds in the UK and Europe over the next couple of months. So looking for those clearer divergence trades, in our view, would be a good relative value way of thinking about this.
Short sterling Aussie is quite an interesting pair to pick, given that you're more nervous about risky assets, and Aussie's a little bit more of a pro-growth currency. Obviously got the commodity angle. Does that reflect a more positive view on China generally and China-related plays?
I think so. I think, obviously, sterling Aussie, we've noted that it's fairly high beta now, and both currencies are fairly high beta. So that trade where Aussie usually gets sold off in a risk sell-off is a bit more short term, and we're not necessarily seeing that follow through in a higher sterling Aussie as well. So yeah, I think that divergent story with China easing, potentially fiscal policy easing as well early next year will likely support the regional currencies there, and I think definitely an underweight bias in European FX makes sense to us.